Between February and November of 2024, something happened in the financial world that almost nobody in the general public caught. But every serious investor felt in their gut. The richest, sharpest operators on the planet weren't just trimming positions or rebalancing portfolios. They were dumping stock in volumes so large and so synchronized that Wall Street analysts quietly started calling it the migration. Jeff Bezos unloaded $13 billion worth of Amazon shares. Mark Zuckerberg cashed out more than $9 billion in Meta stock, month after month. Jamie Dimon, who had gone nearly 2 decades without selling a single share of JP Morgan, suddenly liquidated part of his stake for the first time since taking over the bank in 2005. Larry Ellison let go of $3 billion in Oracle stock. The Walton family, the kings and queens of old money retail stability, collectively sold more than $2.3 billion in Walmart stock. And Nvidia insiders? While the world was hypnotized by the AI boom, employees and executives were quietly taking over $1.2 billion off the table, even as they told the public, we're just getting started. People want to believe these are isolated decisions. Estate planning, tax strategy, diversification, the usual boring explanations. But this isn't that. This isn't a handful of executives tidying their balance sheets for accountants. This is a coordinated exit, a stampede. And what makes this unnerving is that it mirrors, almost line for line, the exact insider behavior we saw in 2007, right before the global financial system vaporized $16 trillion in wealth and sent the market into a 57% freefall. Here's the part most people sleep on. The individuals selling today aren't normal investors. Bezos isn't some anxious retiree panicking over inflation. Zuckerberg isn't doom-scrolling CNBC trying to time interest rates. Jamie Dimon doesn't make decisions based on vibes. These men have spent decades building and running trillion-dollar machines. Bezos turned a garage startup into a $2 trillion empire and lived through the dot-com crash, the 2008 meltdown, COVID, high inflation. Yet in 30 years, he has never sold stock like this. Dimon has literally steered America's largest bank through every financial disaster of the 21st century, and he never touched his stock, not once, until now. These people don't react emotionally. They don't guess. They move when the numbers tell them to move. And right now, the numbers are screaming one thing: leave. Before I show you how deep this goes, you need to understand what insider selling actually means. Most people throw around the term without understanding how powerful it is. Insiders are the only investors on Earth with a full backstage view of their companies. They see the real-time metrics you never will: Amazon's daily sales patterns, AWS margin fluctuations, internal cost projections, future layoffs, supply chain delays, all before they hit earnings, reports. At JP Morgan, Dimon sees up to the minute loan delinquency data, credit card defaults, corporate bankruptcies forming months before they ever become public. These executives operate with non-public information legally as part of their jobs. They know when the engine starts vibrating long before the check engine light turns on. Legally, insiders must report their stock sales to the SEC within 2 business days. These filings are public. Anyone can look at them. Almost no one does. Yet these filings have predicted every major market peak since the 1970s. That's where the Washington service comes in. They've tracked insider activity since 1975, creating one of the most predictive indicators in finance. The insider sell to buy ratio. How many dollars of stock insiders are selling relative to how much they're buying? A healthy ratio is between 2.1 and 3.1. Executives naturally sell more than they buy because compensation often comes in stock. Selling 2 or 3 times as much as you're buying is normal corporate life. But when this ratio explodes past 5:1, it becomes a warning. When it hits 8:1, it becomes a siren. And in 2024, the ratio didn't hit 8 to 1. It didn't hit 10 to 1. It hit 14 to 1 in certain months and finished the year at 9 to 1, the highest reading since 2007. In plain English, insiders are selling $9 of stock for every dollar they're buying. That level of imbalance almost never happens in calm markets. It happens before storms. And this isn't abstract. Look at the numbers. Bezos sold over $13 billion, not over a decade, but in two concentrated bursts at all-time highs. Zuckerberg offloaded stock in nearly every month of the year, riding Meta's explosive rise from $90 in 2022 to over $500 in 2024. Diamond, who spent 18 years preaching that CEOs should never sell stock if they believed in their own companies, suddenly cashed out $160 million. Ellison liquidated billions at the very peak of the AI infrastructure hype. The Walton family cashed out billions with Walmart near record valuations. Nvidia insiders pulled over $1 billion out while the entire world was convinced AI could only go up. By the end of 2024, total insider selling hit $464 billion, the second highest year in recorded history. The only year with more was 2007, and we all know what 2008 looked like after that. Now that you've seen the raw numbers, let me take you into the patterns. Because when you line up 50 years of data, something disturbing becomes impossible to ignore. The next question you should be asking is the one that matters. Does this actually predict a crash? History doesn't just suggest it. It practically shoves your face into the evidence. Insider selling isn't noise. It's not a rumor. It's the closest thing the market has to a seismograph. And every time that needle has slammed into the red, a quake followed. The first and most undeniable pattern is that insiders consistently sell 12 to 24 months before major market peaks. Every single time. Go back to 1987. In the first half of that year, insider selling spiked 350%. Executives were unloading stock aggressively while the public was euphoric. The market kept climbing for months, peaking in August. And then October came. Black Monday, the single worst one-day crash in modern financial history. Insiders sold 6 to 8 months before the fall because they saw the pressure building long before anyone else did. Fast forward to 1999 and early 2000. Insider selling hit records just as retail investors were pouring their life savings into tech stocks trading at 100x sales. The Nasdaq peaked in March 2000 and collapsed 78% over 2 years. Once again, insiders bailed out at the peak while the public walked straight into the fire. Then, there's 2007. Insiders unloaded $650 billion, the highest amount ever recorded. The market topped in October 2007, then crashed 57% over the next 17 months. Insiders were out of the building a year before the bottom. This is not coincidence. This is pattern. Pattern 2 is even more precise. The insider sell to buy ratio, the same one that just hit a disturbing 9.1 in 2024, has a perfect record. According to Washington service data, every single time the ratio has exceeded 8 to 1 for an extended period, a major crash followed within 24 months. No exceptions. 0 false alarms. In 1987, the ratio surged to 9 to 1 in June. The crash hit in October. In early 2000, the ratio hit 11 to 1. The dot-com collapse began weeks later. In 2007, the ratio passed 8 to 1 and then spiked above 10 to 1 going into the fall. The Great Financial Crisis began immediately after. Since 1975, this signal has fired 8 times. 8 times the market fell. And today, we're not just at 8 to 1, we're past it. We're deep into the danger zone with readings as high as 12 to 1 in certain months. If history holds, and it has for nearly 50 years, a crash window opens in late 2025 and stays open through 2026. Pattern 3 is about where insiders sell. They always get out of the most overvalued sectors first. In 2000, Tech executives were selling while journalists were writing headlines about a new economy. They knew those valuations were engineered on hallucination. The Nasdaq fell 78% and took a decade to recover. In 2007, financial insiders sold early because they knew the toxic mortgage sludge hidden in their balance sheets. Lehman, Bear Stearns, Countrywide, all their executives cashed out before the public knew anything was wrong. Financials cratered 80% plus. Today, it's happening again. Tech leaders, Amazon, Meta, Nvidia, Oracle, are offloading billions. Financial insiders, led by JP Morgan's Jamie Dimon, are selling as commercial real estate delinquencies rise behind the scenes. Two sectors. The same two that led the last two major crashes. And this time, both are flashing red simultaneously. Pattern 4 is subtle, but devastating. When the most legendary long-term holders, the ones who never sell, finally do, the top is in. Bezos held Amazon for 30 years, through every recession and crisis, without ever making a panic move. Zuckerberg held Meta since 2004, riding it through every scandal, downturn, and meltdown. Dimon held JP Morgan stock for 18 years straight, refusing to sell during the worst crises of our lifetime because he wanted to signal confidence. Ellison held Oracle for nearly half a century. These aren't traders. These aren't speculators. These are founders and empire builders with multi-decade horizons. And when these men sell billions at all-time highs simultaneously, it's because they believe prices will not be this good again for years. Builders don't sell unless they truly believe the peak has arrived. And then there's pattern 5, the one almost nobody talks about, but insiders never ignore. Massive insider selling has never been followed by new market highs within 24 months. Not once. When insider selling exceeds $400 billion in a single year, the market either crashes or enters a multi-year stagnation. In 1987, sales surged, and the crash hit immediately. It took 2 full years for new highs. In 2000, sales hit extreme levels. It took 7 years for the S&P to recover. In 2007, $650 billion sold. The market didn't reach those highs again until 2013. And now, 2024 has logged $464 billion in insider sales, the second highest year on record. If the pattern repeats, and history says it will, the S&P won't make a new high for 3 to 5 years after the peak we're living through now. When you stack these 5 patterns together, the timing, the ratios, the sector behavior, the long-term holders, and the historical aftermath, they form the same silhouette that appeared before every major collapse of the past half-century. And that silhouette is forming again, right now. But here's the part the billionaires themselves won't tell you: why they're selling. What exactly they're seeing in their private dashboards, their non-public data streams, their internal forecasts that has them quietly walking out of the market while everyone else celebrates new highs. That's where we go next, into the hidden metrics and internal signals the public never sees. The billionaire exodus makes perfect sense the moment you understand what these people can see that you can't. They operate with a level of visibility no retail investor, and not even most institutional investors, can dream of. They don't wait for CNBC. They don't wait for the Fed. They don't wait for quarterly reports. Their dashboards update in real time. Their analysts feed them information before it ever appears in official data. And when you examine the signals they're responding to, the picture becomes brutally clear. The system is stretched, overvalued, and fragile in ways we haven't witnessed since the late 1920s. Start with the Buffett indicator. Warren Buffett's personal favorite measure of market valuation. It's simple: total U.S. stock market capitalization divided by GDP. When the market is worth more than the country's entire economic output, something is off. Historically, a reading between 80% and 100% is fair value. Above 120% is expensive. Above 150% is bubble territory. Today, that ratio isn't 120% or 150%. It's sitting near 185%, higher than every moment in history except a brief, artificial spike during the COVID stimulus frenzy. To justify 185%, you'd have to believe either A, the economy is about to grow 50% faster than any decade in American history, or B, corporate profits are about to double despite slowing growth and rising costs. Billionaires don't believe fairy tales. They know this has to revert. And reversion from 185% back to normal implies a market drop of roughly 45-50%. Then there's the Shiller PE, also called the CAPE ratio, one of the most accurate long-term predictors of stock returns ever developed. It takes 10 years of inflation-adjusted earnings to smooth out economic cycles. A normal reading is around 16 to 17. Under 12 is cheap. Above 25 is expensive. Above 30 is a bubble. Today, it's hovering at 34. Only 3 periods in history have had higher readings: 1929, 2000, and briefly during COVID. And every one of those episodes was followed by a brutal crash. In the words of Robert Shiller himself, high CAPE ratios have always implied significant risk and lower future returns. Billionaires know this metric better than anyone, and they are acting accordingly. But valuations aren't the only warning. The third signal, the one that insiders treat like a nuclear alarm, is leverage. Margin debt recently hit about $950 billion, near its all-time high. Margin is borrowed money used to buy stocks. It amplifies gains in good times, but acts like dynamite during downturns. A 10% market drop becomes a 20% loss for leveraged investors. A 30% drop triggers widespread margin calls as brokers force liquidations. This isn't theoretical. It's exactly what happened in 2008. Margin debt was elevated, the market dipped, and the forced selling drove the crash deeper and faster. Debt collapsed from $850 billion to $280 billion in 18 months. A $570 billion liquidation cycle. We're right back at those levels. Billionaires don't sit around waiting to become collateral damage in someone else's margin cascade. They exit before the first domino falls. Then we move to commercial real estate, an iceberg the public barely notices, but banks feel every second. Office occupancy is sitting at 50% or less in major cities. Buildings purchased in 2019-2021 at peak prices with 3% loans are now worth 30 to 40% less. Those loans are rolling over. Refinancing now costs 7 to 8%. Many borrowers can't service the new payments. Buildings are handed back to lenders. Banks take losses. And those losses don't happen quietly. They ripple through the entire financial system. Jamie Dimon sees this in real time. He knows how many loans are delinquent. He knows which borrowers are days away from default. And he is selling. But the real earthquake is in the corporate debt market. From 2009 to 2021, companies gorged themselves on ultra-cheap debt, borrowing trillions at 2 to 3% interest rates. Now, that debt is maturing. It must be refinanced at 6 to 8%. Many corporations simply cannot survive the cost jump. We're already seeing casualties: Bed Bath & Beyond, Rite Aid, Party City, Silicon Valley Bank. And this is just the opening act. Between 2024 and 2026, $4.7 trillion in corporate bonds come due. If even 10% default, that's a nuclear-level shock to the system. Bondholders get crushed. Banks freeze lending. Stocks tank. Insiders know which companies can't refinance. They see their own balance sheets months before the public does. And hovering over all of this is the most dangerous structural issue in the American economy: federal debt. The U.S. owes over $36 trillion. Annual deficits exceed $2.4 trillion. Interest payments alone are now $1.2 trillion, more than the country spends on defense. If rates stay at current levels, interest could hit $1.8 trillion by 2027. This is mathematically unmanageable. The government will be forced into one of 3 choices: slash spending by amounts that are politically impossible, raise taxes aggressively, or print money. Printing leads to currency devaluation and inflation, both deeply destructive. Billionaires see this future. They diversify away from dollar-only exposure because they understand a basic principle. No empire in history has survived a debt spiral without sacrifice. But the most important signal, the one insiders trust above all else, is the deterioration inside their own companies. Bezos sees Amazon's internal dashboards, slowing real sales growth, declining ad effectiveness, AWS clients cutting spending. Zuckerberg sees Meta's engagement data, declining time spent, downward pressure on ad pricing, rising AI infrastructure costs with uncertain payoffs. Diamond sees JP Morgan's credit data, rising charge-offs, climbing delinquencies, deteriorating borrower quality. This data doesn't show up in earnings reports until months later, after the stock has already fallen. Insiders aren't reacting to headlines. They're reacting to numbers you don't get to see yet. Put these 7 signals together, and the conclusion becomes unavoidable. Stocks are overvalued by 40 to 50%. The economy is slowing into recession territory. Corporate and real estate defaults are accelerating. Government debt is exploding, and internal company metrics are breaking down. Upside from here is limited. Downside is enormous. Now, the question becomes, when? When does this all convert into a market event? History gives us the answer. The lag between extreme insider selling and a major crash is typically 6 to 18 months. 1987, 6 months. 2000, immediate. 2007, concurrent. In 2024, the selling peaked in Q2 and Q3. That puts the danger window squarely between Q3 2025 and Q2 2026. And the timing couldn't be worse. Election cycle volatility, commercial real estate maturities, corporate debt rollovers, and federal deficits all peak in that same window. Which means the next 12 to 18 months are not just risky, they are historically dangerous. Now, we need to talk about consequences. Who wins, who gets wiped out, and how ordinary people can position themselves before the cascade begins. When markets break, they don't distribute pain and opportunity equally. Crashes are not democratic. They punish the exposed and reward the prepared. They destroy decades of savings for some while creating generational wealth for others. And every major financial collapse in history has followed the same pattern. Insiders exit before the fall. The middle class takes the hit, and those holding cash or hard assets step into the wreckage to buy the world on discount. What's about to happen is no different. The first group of winners is obvious: the billionaire insiders who already sold. Jeff Bezos dumped $13 billion at $170 to $180 a share. If Amazon falls 50%, and history suggests it can, those shares return to the $85-90 range. He can buy back twice as many shares for the same money. That's not a guess. That's how insiders grow their empires after every crash. Mark Zuckerberg sold more than $9 billion at $450 to $500. If Meta retraces by half, he can load up at $225 to $250. Jamie Dimon sold at $155, $165. If JP Morgan drops to the $95 to $100 range in a recession, his sale turns into a 50% round trip gain. Billionaires play a different game because they understand the rules. Sell high, wait, then buy back low. Crashes are how they accumulate more control, not less. The second group of winners will be people sitting on cash and gold. Cash is ignored during booms, but becomes a weapon during collapses. When stocks fall 40 to 60%, cash turns into a lever. It buys assets at half price. That's how generational fortunes are built, not during euphoria, but in the ashes of forced selling. Gold plays a different role. It protects purchasing power when governments panic. In every crisis, 2008, 2020, the stagflation of the 1970s, gold surged as the Federal Reserve printed trillions to stabilize the system. When liquidity floods the economy and the dollar weakens, hard assets rise. A 10-20% allocation to physical gold or a reputable fund has historically shielded wealth while stocks bleed out. A third class of winners exists, but with a warning label: short sellers. People like Michael Burry, who made $700 million by shorting subprime mortgages in 2008. John Paulson, who made $15 billion. Bill Ackman, who made $2.6 billion shorting credit in early 2020. These traders bet directly on collapse. But this is a razor blade strategy. You can be right about the crash and still get destroyed if your timing is off by months. Most people should not short. Even most professionals avoid it, except under perfect conditions. Then, there are the losers. And this is where the real human cost shows up. The middle class, once again, will absorb the majority of the damage. Their wealth is concentrated in three places: retirement accounts, home equity, and basic savings. Retirement accounts like 401ks are often 70 to 80% in stocks. If the market drops 50%, decades of work evaporate instantly. Imagine a 65-year-old with $800,000 saved for retirement. A 50% crash cuts that to $400,000. They can't rebuild. They can't wait for the rebound. Their timing is unlucky, and their future collapses through no fault of their own. This is the tragedy of retire at the top. Pension funds and large institutions get crushed as well. CalPERS, managing nearly $500 billion, would lose $200+ billion in a severe downturn. Benefits get cut, obligations go unmet, and taxpayers face the fallout. Insurance companies, which rely heavily on bond and equity portfolios, face solvency risks. If both markets decline, they can't meet claims. People lose coverage. Systems buckle under pressure. Leverage amplifies all of this. Anyone who bought stocks with borrowed money faces mathematical disaster. If you bought $100,000 in stock using $50,000 of margin, a 50% market crash wipes you out completely. Not partially, completely. You owe the broker money. Leverage is a wealth destroyer during crashes, and millions of people are unknowingly leveraged through their brokerages, ETFs, or structured products. Crashes reveal the real cost of borrowed optimism. This is how wealth transfers in a crisis. Not through conspiracy, but through structure. Billionaires protect capital. The middle class stays exposed. When markets fall, money moves from the unprepared to the informed, from those who freeze to those who act, from those who hope to those who position early. So what can you actually do right now? First, reduce equity exposure. Not eliminate, not panic sell, just reduce. If your portfolio is 80% stocks, take it down to 40 to 50%. The goal isn't to time the exact top. It's to avoid taking a 50% hit when you don't need to. This is exactly what the insiders are doing. They are raising cash, not shorting the market. Second, allocate 10 to 15% to gold. Physical gold or a reliable ETF. Gold is insurance, not a growth asset. In 2008 to 2011, it doubled. In 2020, 2021, it surged again. When the Fed eventually reacts to the crash by printing trillions, gold will protect your purchasing power while the dollar weakens. Third, create a buy list now. Know which companies you want to own when everything is on sale. Not memes, not hype stocks. Real businesses with fortress balance sheets. Apple, Microsoft, Visa, Costco, Johnson & Johnson. In every crash, the public panics, while insiders quietly accumulate positions in companies like these at 30 to 50% off. If you walk into a crash without a buy list, you'll freeze. If you walk in prepared, you'll act. Fourth, don't short unless you're an expert. Even billionaires are not shorting today. They're selling, holding cash, waiting. Shorting requires flawless timing. The market can stay irrational far longer than you can stay solvent. Let professionals play that game. Fifth, protect your income. Build an emergency fund that covers at least 12 months of expenses. Unemployment spikes during recessions. Having cash on hand lets you survive layoffs without liquidating. Investments at the bottom. Sixth, prepare psychologically. This is the part most people underestimate. When the crash comes, headlines will scream collapse. Friends will panic. Your account balances will plunge. Every instinct will tell you to sell at the bottom. But that moment, the darkest moment, is when wealth is made. Prepare your mind now so you're not controlled by fear later. Let me leave you with this final truth. The billionaire exodus isn't myth, rumor, or coincidence. It's the largest insider sell-off since 2007. Over $50 billion sold directly by the richest operators on Earth, and $464 billion in total insider selling, the second highest level in history. The sell-to-buy ratio hit 9-to-1, an alarm level that has predicted every crash for half a century. The Buffett indicator is flashing red. The Shiller PE is screaming bubble. Margin debt is at extremes. Commercial real estate is cracking. Corporate refinancing risk is exploding. Federal debt is spiraling. Internal company data is deteriorating behind the scenes. This is not normal. This is the pattern. The same pattern we saw before 2000. Before 2008. Before every major market collapse in modern history. We are now inside the 12-18 month danger window, Q3 2025 through Q2 2026. Maybe the catalyst arrives sooner. Maybe it arrives later. But the insiders have already spoken with their actions. Bezos selling $13 billion. Zuckerberg selling $9 billion. Diamond selling for the first time in 18 years. The people with the most information, the clearest visibility, and the most to lose are heading for the exits. They're not panic selling. They're not speculating. They're early, but they're not wrong. If this documentary revealed a pattern you hadn't seen before, if you now understand that the largest insider selling event since 2007 is happening right now, you have a choice. You can ignore the signal and hope you're lucky, or you can recognize the pattern and position accordingly. Reduce exposure, raise cash, hold gold, build your buy list, prepare your mind, because the next 12 to 18 months will reshape the financial landscape. The billionaire exodus has begun. The pattern is clear. The crash is coming. Position yourself accordingly.